Hello and welcome to this session. This is Farhat, in which we would look at auditing sales returns and allowances and uncollectible accounts. Now, these two areas, sales returns and allowances and uncollectibles, are part of the sales cycle. And this lecture is part of the sales cycle. Now, at the beginning of this series of lectures, we talked about the sales cycle. Real quick, this is how the sales cycle works, and these are the related accounts. First, we make a sale on credit. We debit account receivable, credit sales. Then the customer might pay 30% of the bill. They will debit cash and we will reduce account receivable. What's left in account receivable is $70,000. At some point, the customer might return $5,000 worth of merchandise. If they do return the merchandise, and this is what we'll be discussing here, sales returns and allowances, if they do return it, we will credit their account receivable $5,000. We debit sales return $5,000. Now remember, sales return is a contra revenue. It reduces your revenue. That's why it gets a debit. And let's assume the customer calls and complains the shipment arrived late. We'll give them an allowance for $1,000. We debit sales return as an allowances, and we credit account receivable. If at some point we might have to write off some of the accounts, that's fine. When we write off an account, we assume in which method we are using, assuming we are using the allowance method, So let's assume this account, what's left, let's assume this account, what's left is 70 minus 6 is 64,000. Let's make this as an extreme example. This customer filed for a bankruptcy. What do we do if they filed for bankruptcy? We credit their account, and we are assuming we're using the allowance method. We debit the allowance $64,000. Now we also assume that we do have some balance in the allowance, but that's beside the point. So the point I'm trying to make here is sales returns and allowances, and the allowance for bad debt and bad debt expense, which we estimate at the end of the year, those are part of the sales cycle. So just want to make sure you know what we are dealing with. It's part of the sales cycle that we've been working with. So when it comes to sales returns and allowances, what are they? I just told you there are adjustments made to the revenue when customer return goods or services, or they receive a discount for defective or unsatisfactory return. Sales return is actual return. When you give them a discount because they're not happy, it's called an allowance. These transactions, oftentimes they are immaterial, because if they are material, it means you're not doing a good job. You're not selling good product. If people keep on returning the product. But they could become a significant concern if they are used to perpetrate fraud. So this is what we have to learn how to audit them. Understanding the risk and implementing control is crucial to prevent financial losses. So companies will have certain controls, and we'll talk about them. About what? To prevent those occurrences, to prevent from allowing someone to either steal from the company or commit fraud through these accounts. And this is what we will discuss in this session. Sales returns and allowances first, then we will discuss uncollectibles. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel, and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
What are the key concerns with sales returns and allowances? First, you want to make sure we have segregation of duties. That's always the case, or separation of duties. to mitigate risk in all cycles, and the sales returns and allowances is no different. So the person that's issuing a credit memo, what is a credit memo? When you return an item, the company will give you credit. Credit could be they could give you your money back, or they can reduce your balance. It's either or. They're giving you some sort of a credit. So the person issuing this credit memo must not handle cash or cash equivalent. And you could have this experience yourself. Sometime when you go to return an item, they send you to a different desk or to a different counter where you would return this item. Why? Because we don't want people to be able to be issuing the credit memo and having access to the cash. Now, why? We're going to see why. Why would that happen? So if one individual has control over issuing the credit memo and managing cash or account receivable, they can exploit this access to commit fraud. For example, an individual could pocket the cash receipt from a customer and issue a credit memo claiming that the customer returned the item. They would issue the memo, looks good, the item is returned. Now, the item is not actually returned. There's another step where we have to do reconciliation. But the fact that this individual can, on the record, claim that the item is returned and issue a credit memo, well, if they return an item, there's like 15 different items of the same size, color on the shelves. We don't know which item they return. Then they could write off the receivable, effectively erasing the evidence of the transaction. So they can do that. So the result here, the fraudster keeps the cash, the customer believes their account is settled, and the financial record appears accurate. So this could happen. That's why we don't want the people issuing the credit memo having access to the cash, or they cannot be able to write off the account. That's another thing, because if they can write off the account, what can they do? They can write off the account, make it disappear. The customer does not care. As long as the customer don't receive a bill, they're okay with that. They don't care, whether you pocketed the money or the money went to the bank balance. So the auditor emphasize here is the occurrence objective. So when you're auditing this, you're concerned with the occurrence. Auditor focus on the occurrence to uncover fraudulent activities. For sales returns and allowances, this is what you want to make sure that you're verifying whether the return are actually occurring. Like these are real. Occurrence means they did happen, they are real. And this is to ensure that no fictitious returns were created to justify stolen cash or manipulating receivable. You want to make sure that's the case. Now, how would you test this? Well, you compare goods, return goods to credit memo issued. So somehow the company should keep track of the credit memo that they issued and the physical evidence, the goods that they returned. So tracing also credit memos to support and documentation such as customer complaint or return merchandise. So you want to make sure you have all the necessary document in the return process, the credit memo, the merchandise. Also, what you want to do here is analyze pattern. What do I mean by pattern? Looking for anomalies, seeing if a particular item is returned all the time, or the return is happening during a certain shift where one person is working or one manager is working. So you want to look at these patterns. For example, you have 3 managers in the store. On average, 2 managers, they have 3,000 worth of returns per month, and one manager, 10,000. Why is that? Why one manager is experiencing 3 times the amount of returns of the other manager? I mean, this is what you will do by analyzing patterns or trend, and we'll talk about analytical procedures later on to look at these anomalies to help you basically zoom in on something unusual happening. This is about sales returns and allowances. Let's talk about uncollectibles. Why are they significant? Uncollectibles, they are significant because what they do is they reduce your sales, reduce your receivable. They represent a receivable that we cannot collect, we cannot recover. Basically, the customers cannot pay their bill. And these are written off as bad debt, which is reducing account receivable and increasing expenses, reducing profit for the company. Now, bad debt, they are a natural, I'm going to put in quote, natural part of business. Why? Because some customers don't pay because they go out of business, there's a dispute, it's the wrong product, they made the wrong decision. It does not really matter. Now, make sure you pay your bills on a personal level. But the point is, it happens. But they could also create an opportunity for fraud because uncollectibles, what you can do, you can overestimate them, underestimate them. As a result, affect AR. As a result, affect also the bottom line through bad that expense. So although you might think it's a small amount, but small amount to learn more about this, the only way is to go to Farhat Lectures. Not the only way. The best way is to go to Farhat Lectures, look at additional resources, MCQs. That's going to help you whether you are an accounting student or a CPA candidate studying for your exam. The CPA exam is worth it. Invest in yourself. Good luck and stay safe.